So right now it's highly asymmetric for an equity investor to be looking at this and say that equities have a good risk reward because the downside is pretty significant. And in terms of the level of the tightness that's being put into the market by the Fed, any type of rate cuts at this juncture would be very negative in terms of earnings that are being expected to grow significantly next year, which would be an issue for the market.
Alfredo Pinel joins us today. He is the head of research at Game of Trade. So we've been talking about his trades, his outlook for the macro landscape, and what exactly is happening right now with our economy. Welcome to the show, Alfredo. Pleasure to host you today.
Thank you, David. Very excited to be here.
Let's recap first what happened this week at the FOMC meeting. So not a lot of surprises in the fact that the Fed did not raise rates. Were you surprised by anything?
In our work, basically our view has been that the run-up in valuations going into this Fed pause is basically been a problem for the market. Essentially, it's created a high vulnerability for stocks today, a very high bar for them to clear. So anything that comes to mind regarding rising interest rates, for example, will be a problem, as well as anything regarding the earnings could be an issue for stocks going forward. So from that standpoint, the issue was that the investors had already discounted a Fed pause going into this, even to a greater extent than prior Fed pauses. If you go back to the 80s, typically when you go into a Fed pause, the market actually doesn't run up the PEs. And when you study these different Fed pauses, the PE expansion actually happens after the Fed has paused. In this case, you saw a significant run-up in PEs going into it. So as I mentioned, that really left the market very vulnerable to these concerns around rising rates. So it's been really more of a sell the Fed pause type of deal.
You have a slide deck, and we'll show a number of slides on the screen here. We'll walk through some of the topics from this slide deck. The first being that you have a section labeled "Expect Big Layoffs in Q1 2024." Now, just to clarify, is that your view, or is that other people's views that you're perhaps trying to debunk?
No, that's our view, David. We're bearish in the economy today. We expect a recession in the first half, and of course, every recession that we've had, a particular characteristic and defining characteristics of that has been rising unemployment. So you can't really get a recession unless you see the unemployment rate move higher here.
Right, but you have another slide here. Now, I'm going to show this slide on the screen. The labor market has proven resilient in 2023. The unemployment rate, as you know, has been relatively low by historical standards and hasn't shown signs of a huge uptick just yet. So despite this resilience, you still think we're going to get worsening labor market conditions by the end of the year?
Yes, we do think that. And if you look at that chart that compares the trajectory of the unemployment rate across different inversion episodes. And the curve inversion is something that we have really put a lot of weight on in terms of our outlook for the macro. And we think that's reasonable because the yield curve has been a pretty successful indicator of where we stand in the cycle. I mean, as far as a quantitative indicator, which is something that we like to look at, it's been pretty reliable across the various recessions we've had in the last few decades. So for us, it's a very unbiased way of looking at the macro. So when you compare across the different episodes of yield curve inversions and you compare the trajectory of the unemployment rate, we can see that today's experience isn't really that far off from the median episode, for example. You can maybe argue that it's not ramped up as much as a lot of people expected, but really we think that around maybe the 15th month mark, following the inversion is when we are going to start seeing a little bit of a ramp up. So we would say that maybe by the first quarter of next year, we'll have definitive data about whether the unemployment rate is moving higher and whether this inversion is actually improving as a correct signal in terms of where we are in the cycle.
So just to clarify, the unemployment rate you think will go higher because people will start laying off soon, or because people will start quitting the job market and look for better jobs?
Well, the quits rate right now is really basically at the level we saw pre-pandemic. So in terms of the tightness of the labor market, we think this is it. We don't think it's going to get any tighter than this. And in fact, it's the opposite. We should expect the labor market to be loosening here. So we think that's really going to be the case because of layoffs. Something that we think has been holding up the market, in the labor market, has been this labor market hoarding that we think has been going on, especially in manufacturing, which is a sector that's been very weak and global trade has been very weak. If you look at China and Europe, very cyclical economies doing very poorly. So when you look at manufacturing and you look at hours worked, is right now showing tendency of being in recession, very similar levels to what we see during recessions. But yet the employment levels in manufacturing haven't really come down. So you have to ask yourself what's going on there. And for us, it's a telltale sign that manufacturers are just hoarding labor because they expect the recession to be mild, and they want to be ready for the rebound because it's been very difficult to find labor, to find workers, to retain these workers. It's been very expensive, and they don't want to let them go. So I think that's the bet they're making, and that's why we see the labor market be proven resilient in a sector as weak as manufacturing. But as the monetary policy lags start to come into effect, cost of borrowing going up, earnings will start coming down, and companies are going to do what they typically do, which is to lay off workers.
Which sectors do you think are most at risk of the highest number of layoffs?
Well, we would have to look at manufacturing. I mean, that's a sector that's been pretty weak. We can't really expect to see a rebound in manufacturing anytime soon unless the Fed eases. I think that's generally what happens. You have to have the Fed stimulate the economy to have something like manufacturing really see some sort of rebound. And as we know, with the core CPI being significantly high relative to prior cycles, it's difficult to see how the Fed is going to be stimulating the economy and trigger this type of rebound in manufacturing. And if they do, most likely it's because the downturn is going to be pretty deep and significant. So from that standpoint, it's hard to see manufacturing really see significant improvement from here. And we would imagine that that's a sector that's going to have some sort of gravitational pull. When you look at hours worked, is really going to converge, and we'll start seeing the layoffs there where the pain has been the biggest.
One thing that I've noticed is that the wealthy people are getting wealthier. If you look at the Federal Reserve data of net wealth by income brackets, the top 1% has roughly $25 trillion of wealth. The bottom 50% has about $3.4 trillion. So the top 1% has 8 times more wealth than the entire bottom 50%. And that wealth seems to have increased this year along with the rising markets, along with rising real estate, because the wealthy own assets. Now, my point is, Alfredo, is it not possible that even though we may see layoffs in certain sectors rising, the wealthy people will still continue to drive demand and perhaps curtail some of the pain in some of these sectors because there's still wealth to be distributed?
Yeah, that's a good question, David. I think the wealth effects could be playing a role here. That's not something that we put a lot of weight at Game of Trades in terms of what really drives the economy. The marginal propensity to consume is always been bigger among the low earners. And that's really where I think the focus needs to be in. When you look at something like housing, for example, where prices have held up, I mean, in reality, that's really not that unusual given the weakness in existing home sales, for example. I think a lot of people are asking themselves, how come we've seen this swoon in housing, but we haven't really seen a big decline in home prices? And the answer to that is that home prices show a lot of inertia whenever you see mortgage rates move up. It's just a market. It's not like a tradable market. It's not like the stock market. So prices tend to be slow moving, and the adjustment to the tighter economy generally comes from just a decline in the number of transactions in existing home sales, which is what you're seeing today. So from that standpoint, the decline in home prices, which you could say existing home sales is a good leading indicator into it, the decline in home prices is something that maybe we can expect at some point down the road, not right now. So from that standpoint, wealth effects related to the housing market is something that could be arguably be holding up spending, but we don't think it's a big effect, and most likely we'll likely see a decline in home prices at some point in the future.
Do you have an expectation as to how high the unemployment rate could go? Talking about U3 unemployment.
Well, not really. We can study different cycles in terms of how high the unemployment rate could go, and look at what the Fed is forecasting, for example, in terms of unemployment. But what we do is that we basically look at what's happened in prior inversions in terms of the directionality of the labor market, and the fact that it's at a very low level today, it's perhaps indicative that you could have some runway for the labor market to really deteriorate from here, as has been the case in prior inversions. The issue right now is that the conditions, as I mentioned, in terms of what are some of these channels that could really trigger the decline in the labor market, are being held up by this lingering effects of fiscal stimulus, whereby there was been a lot of excess savings in the system, and therefore that's really propelled consumer spending. And that, in combination with the hoarding that we've seen in the labor market, could mean that we're going to see the unemployment rate move higher in a gradual manner. So that's the argument against the bears right now, that it's just going to be a timing issue. But at the end of the day, the unemployment rate is something that we need to see move higher. We think it will happen by the Q1 of next year, and that's going to precipitate the downturn.
So are you expecting then the Fed to pivot by Q1 next year? Keep in mind, they also look at the unemployment rate, well, the health of the economy overall. And if your analysis is correct that we have a huge spike or even a gradual spike in unemployment, that could signal a slowdown in the economy, which may prompt the Fed to cut rates? No?
Yes, there's absolutely the case that the Fed can cut rates. That's the issue, is that that's really not being priced in the market, especially in something like equities. And you have to look at something like 2000, right, where the Fed cut rates, but the valuation starting point was too high, and therefore the cutting or the loosening of monetary policy eventually was seen as a bad sign for the economy, because it meant that the earnings were going to deflate, and that's what's happened. And therefore the PEs took a hit, and so did the market. So from that standpoint, that's really the issue, that we can have a situation where even if the Fed cuts rates, it will be under an environment that's signaling that the economy is much weaker than expected, and that the recession is probably going to be deeper than expected. So that's not going to be good news for an equity market that's so far now being held up by PEs that are pricing a significant inflection point in earnings in the next year.
Well, this comes to the issue of interest rates. Let's talk about this first slide. The runway for more tightening looks limited. So the 10-year yield, as you know, has been rising all year. The real yield of importance has been positive and rising again. What's the significance of the real yield going up?
Yes, the real yield going up is a sign that the cost of borrowing is going up relative to the purchasing power of households and the economy in general. And that's really the issue. It's hindering growth, and therefore at some point hindering corporate earnings. And that's really the rate that matters when it comes to valuations of something like equities, for example. You have to account for the purchasing power of the economy, and that's why real yields matter. And at some point, we expect that real rates are going to constrict the economy, as they generally do, and that the Fed is going to cut the nominal rate. But we think that at this juncture is highly asymmetric, though, because we have seen this big ramp up in the real yield as the Fed started aggressively hiking interest rates, and it's gotten to a point right now where it's very constrictive. And one way that we can look at that is by taking the real 10-year yield and comparing it with a proxy for the neutral rate. The neutral rate, of course, being the equilibrium rate, where the economy is basically operating at full employment and is not stoking inflation. Now, the question is, what do we use for the real neutral rate? And the Fed has done some work on this, and there's a good estimate that we can come up with, priced by the market, which is a real five-year rate. Essentially, what is the real interest rate 5 years from now over a duration of 5 years? It's long enough that we can say, in terms of horizon, that we can say that it really captures the market's expectation of what the neutral rate will be. And when you compare the spread between the 10-year yield, the real 10-year yield, and that real five-year yield, is right now at a very constrictive level relative to the last few decades. If you go back to the 80s, is at a record high, and much higher than levels where we've seen recessions take place. So right now it's highly asymmetric for an equity investor to be looking at this and say that equities have a good risk reward, because the downside is pretty significant. And in terms of the level of the tightness that's being put into the market by the Fed. Any type of rate cuts at this juncture would be very negative in terms of earnings that are being expected to grow significantly next year, which would be an issue for the market.
Do you think consumers can withstand this level of interest rate?
Well, right now, if you look at the data, consumer spending seems to be able to hold up well, but there have been some pretty significant changes that we've seen recently. One of them has been the student loan moratorium that's being lifted, and it's very difficult to say for sure what type of impact that's going to have on spending, but also just more generally, the excess savings that have kept up consumer spending strong in the last year or so, that we expect to be depleting by the end of this year. So from that standpoint, there are some concerns around the longevity to where consumer spending can remain strong. And right now, also these concerns around rising oil prices, that could also be an issue for discretionary incomes for on the spending side of things. That's really what matters for earnings. Good spending is really what matters for earnings in the S&P 500. So we ultimately need to see that spending really weaken for these earnings to be proving too high for next year.
Yeah, I have a chart here that I'd like to draw your attention. This is from the St. Louis Fed. It's household debt service payments as a percentage of disposable personal income. Now, before I looked at this chart last night, I thought to myself, okay, I know that in nominal terms, credit card debt is at all-time highs. I know in nominal terms, consumer credit is near all-time highs. I know, of course, like we talked about, real rates are going up. Nominal rates have, of course, gone up. So naturally, the consumer must be suffering. But then I thought, let's take a look at the income side of the equation as well. And sure enough, the debt service payment as a percentage of disposable income is near its 30-year lows. So to put it into perspective, in 2009, it was near 13%. 2008, it was near 13%. It's currently hovering at around 9.6%. It peaked in Q4 2022 at 9.7 and has been slightly rolling down. My point is, Alfredo, it looks like people have more disposable income relative to their level of debt payments, historically speaking. So my assessment is that the consumer is still able to withstand interest rates at current levels. Do you agree or disagree?
Well, I disagree. I think looking at things from a level basis, certainly what you say, that's what the data is showing. But we also need to take a look at the rates of change and also the growth rates here in terms of, if the level is down, what happens to the consumer at more of the incremental or marginal level. If the consumer sees that, for example, gas prices are moving higher, they need to pay more on their student loans, that's going to be an issue. And the fact that the level, in terms of what you described regarding the burden of the interest expense is low by historical standards, I don't think tells us much about what's going to happen over the next year. It really also depends on what type of shock we get in the system. If the unemployment rate starts to move higher because of concerns, as we described, regarding the potential for people to lose their jobs because there's a lot of hoarding in the labor market and the earnings start to move lower and companies decide to keep their margins higher and cut people, then we're going to have a problem. So from that standpoint, I'm not paying too much attention to the level. It is really more what happens over the next year in terms of the incrementals.
So what is your projection then for what the Fed may do? Again, going back to what they did this week, they paused. They signaled that they would keep rates elevated until the job of fighting inflation is done. At what point do you think they could pivot, if that's even in the cards?
Yeah, I think in terms of what would actually drive them to change their stance, it would most likely have to be the labor market. If we start seeing that earnings of the S&P 500 start weakening, then most likely you're going to see companies start to lay off workers. So from that standpoint, I think it really depends on how long these monetary policy lags take to weaken the economy. And keeping track of where the unemployment is, the claims, where they're headed, or how they have been doing, I think that's important to keep track on a real-time basis how the labor market is doing. But once we get to that level where we have this issue with the labor market be really front of mind for the Fed, at that point, we have to really ask ourselves, is the pivot going to be really a savior here for equities, given just what's being discounted, or is it going to be more like 2000, where you have a big decline in earnings and the PEs are just too high, and essentially you have a swoon in the market? There's also some other concerns that are perhaps coming from abroad. We have weakness in China, weakness in Europe, and some work that we have done at Game of Trades recently is really looking at those spillover effects from Europe into the US, what do they look like quantitatively, systematically, in terms of a growth shock in Europe? How does that translate to the US in terms of the performance of stocks, the performance of, let's say, commodities and bonds and sectors? And what you typically see is that stocks get hurt. The S&P 500 is a group of multinational companies with a lot of exposure non-US. And therefore, these companies are already reflecting weakness in Q2. Companies with high earnings exposure outside the US are showing declines in growth rates, declines in revenue, for example, declines in earnings. So that's already impacting the earnings side of the equation. And we would expect, if that has legs, to really have a meaningful impact on equities in the US. So we have to also take into account these other external factors.
So let's talk about oil. You have a number of important slides highlighting how oil may be painful for consumers, especially at the prices that they are at now. Let me just ask you, Alfredo, we know that oil has increased in the last couple of months. Do you think that at current levels, crude oil will put significant pressure on consumers, or do you think that it will go even higher and it's only at higher levels that we will start feeling pain?
Most likely, I would say at higher levels. In our work on oil, we feel like it's going to get to $100. That's our expectation. If you look at things like the break-even rates, if you look at what the bond market is saying through the break-even rates are really not validating the move higher in oil today. And we have to ask ourselves why that's the case. The bond market has been, in our view, more correct than the crude oil market since COVID in terms of determining what have been the inflection points. If you look at break-evens, for example, they anticipated after the reopening of the global economy, they anticipated the rebound in oil prices. They also anticipated the peak in oil following the invasion of Russia of Ukraine. So the bond market, we think, is a little bit more credible in terms of determining this dynamic between oil and inflation. So from that standpoint, we think that the runway right now for oil is pretty low. It can maybe get to $100. That's our expectations. But because it's not being really validated in the market by these break-evens, by the bond market, and also given the strength in the dollar that we've seen recently, the dollar is a very key macro variable for commodities and oil. So there's been a little bit of dislocation there recently in terms of oil prices moving higher, even though the dollar has been strengthening. When you take all of those things into account, we really don't see a big runway for oil to really come in here and really have an issue with the consumer. Now, I would say that if that does occur, if we do see oil prices move higher from here, say higher than $100, that would certainly be a problem, because that's really not being priced by the commodity markets. If you look at the forward curve for oil, it's not really pricing anything over $100 in the next few months. So that would really be a contrarian move here if oil prices do move higher, let's say, because you have a big supply shock, aside from what we've seen from Saudi Arabia and Russia in terms of cutting production through the year end. If you had any other type of shock in the system and that really moves oil prices higher than $100, then that would really be very disruptive.
So would you be buying oil right now at current levels if you were trading it?
No, we would not. Trading at $90 with a runway of $100, we wouldn't really see that as a big asymmetric bet for us. So from that standpoint, we like I mentioned, we have to really put some faith in something. And in our case, the bond market, we think, is more correct than the crude oil market here in terms of the runway that we can see.
Let's just wrap up your trade allocations then. So you do work at Game of Trades, so we'll talk about exactly what your research entails in just a minute. So maybe give us a highlight of some of the best and worst assets that you've got your portfolio allocated to right now.
Right. So we have been very much bearish on the economy, expecting a recession based on this yield curve inversion. As I mentioned, the yield curve inversion for us has been an important factor in trying to time the recession and also in terms of the depth of the recession. So for us, what you would expect, of course, is to have defensives in the portfolio. So we've had a significant exposure to long-term bonds for some time. Now that's taken a while, as we know, to play out, given these more recent concerns around the fiscal sustainability of the U.S. government debt. That's been an issue, a little bit of a shock for the bond market more recently. So that's hurt the portfolio somewhat. And we've also had some great trades. We had silver and gold in our portfolio around the time when China announced that they would be removing the COVID limitations that were prevailing last year, and that really moved the dollar lower and boosted our allocation to precious metals. So that's been really a winning trade there. And in terms of precious metals, right now, though, they are in a little bit of a limbo because of what's happening with China. So we really need to see a catalyst there for precious metals to continue their momentum higher. And we think that can only really come if China were to really stimulate significantly here the economy. We really need to see something where the dollar weakens here and these precious metals can really take off. More recently, we've also added exposures to Turkish stocks, just based on the policy pivot that's happening there. That's also been a very good trade that's worked for us, and we expect that to continue. So we do a lot of work on a game of trades around many different asset classes globally, and we have a portfolio in our service with all of these ideas and recommendations.
What's your outlook on fixed income versus gold? Do you think gold still stacks up to bonds in this high interest rate environment, even though they both offer, I guess, in some investors' eyes, similar levels of risk, but bonds yield a little bit more?
Right. Yeah. In our work, we actually have both precious metals and bonds. So we have gold. We actually have physical gold. We have gold miners, and we also have long treasury bonds through the TLT ETF. So from that standpoint, we believe that a diversified bet on a recession here makes sense. We don't really have a strong view on whether we should be holding more gold versus bonds. As I mentioned, we have had these new concerns around the sustainability of the debt for something like long treasury bonds, for example. So from that standpoint, what we have done is that we've actually hedged our portfolio by buying insurance against this continuation in move higher in rates. So we are hedged in our bond allocation, but we have to remember that something like gold and silver, they really need two things to work in their favor. They need real yields to move lower, and they need a dollar to move lower. So from that standpoint, the precious metals trade, as I mentioned, really needs to see some sort of catalyst here to really continue its momentum that built up since November of last year. But we think a diversified bet, holding both, makes sense.
Are you bearish on all risk assets, or is it just stocks? Let's take Bitcoin or cryptocurrencies, for example. Is your view towards cryptocurrencies and Bitcoin in particular aligned with stocks, or are they different for you?
Yeah, that's an interesting question because Bitcoin has seen some of the correlation that with stocks, for example, that really shot up after COVID because of the fiscal stimulus. It really drove this correlation higher between Bitcoin and stocks, but that's really been breaking down more recently. So from that standpoint, there's been a little bit of a disconnect from a risk standpoint between stocks and Bitcoin, for example. But we don't really see, despite the fact of that breakdown in correlation, we don't really see Bitcoin performing well as a risk asset relative to something like stocks, for example. So from that standpoint, given our negative view on the economy, we don't really see Bitcoin as an opportunity here. And the fact that there could be some upside potential in Bitcoin regarding the adoption by institutions of ETFs that are holding Bitcoin, that's an idiosyncratic story that could play out. But I think we ultimately need to see risk sentiment really turn up higher here for that story to really catalyze.
Alfredo, where can we learn more about your work and Game of Trades, and what can we expect to learn from Game of Trades?
Yeah, a game of trades, we put a lot of emphasis in combining the macro with the technicals, with the quantitative frameworks, and I think that really makes us unique. Right now we're doing a lot of work on, for example, Turkish stocks, for example, Brazilian stocks. We're looking at EM as an opportunity for investors like us that are pessimistic on U.S. stocks to look for these more idiosyncratic, non-correlated exposures to the U.S. market. So from that standpoint, if you're looking for ideas, we're an idea generator, and we use different frameworks to make sure that we can come up with a very high risk reward for these different trades. And we have a model portfolio in our service that has all of these ideas, and we track the performance. We're very transparent with how these ideas are going, the performance of these trades. So we're doing a lot of work right now across different asset classes with the intention of providing to our members the highest quality type of idea that they can get in the market.
Well, I appreciate you coming on the show and giving us your insights. Follow Game of Trades in the link in the description down below, and we'll have more for you from Alfredo and his team in future episodes. Thank you for coming, and I look forward to speaking with you again.
All right, David, thank you. Really appreciate it.
And thank you for watching this episode. I'm David Lin. Don't forget to subscribe and like this video.